Okay, so let's just jump right into it. The major headline we all saw this week was simple. It was pretty straightforward and, well, honestly, widely expected. The Federal Reserve cut interest rates on Wednesday.
Yeah, and to be honest, it wasn't a shocker at all.
Not at all.
If you were watching the market ahead of that meeting, I mean, something like a 90% probability was already priced in for this exact outcome.
Exactly.
Yeah.
A 90% probability. So, everyone basically knew this was coming, but the mission for this deep dive is to look past that really predictable headline. We want to explore the surprising tension that's really bubbling up just underneath the surface. We're going to examine an unprecedented and frankly fascinating level of division inside the Fed's policymaking body. And we're also going to highlight this really critical, quantifiable gap between the Fed's official projection for the future and, well, what the financial market is betting on right now.
Yeah.
You really need to know what that disagreement is and, why it matters to your money.
And that all starts with the context of the cut itself. Just for the record, the specifics were pretty simple. The federal funds rate is now set at a target range of 3.5% to 3.75%,
Okay.
which is a standard quarter of a percentage point lower than where it was before. And this rate, of course, is what commercial banks charge each other for overnight loans, so it ends up influencing everything. Mortgages, business loans, all of it.
And when we talk about the historical context here, we have to recognize where we are in this whole cycle.
Absolutely. This cut is actually the third one of 2025.
Right.
And those three followed three other cuts that happened all throughout 2024. If you just look back a couple of years, the Fed was fighting inflation that had hit, multi-decade highs. They were aggressively raising rates to slow everything down. Now inflation has cooled off a lot, and the Fed has sort of shifted into reverse, bringing rates down gradually.
A measured path.
It's a measured, consistent path of easing. But the key insight here, the real takeaway, is that the agreement within the Fed's leadership about the pace and the timing of that path is, it's fundamentally dissolving.
And that brings us right to the internal drama. This is where it gets really interesting. The federal funds rate, this powerful lever that influences the entire economy, is set by the Federal Open Markets Committee. We just call the FOMC. These are the policy-making masters of the Fed, 12 voting members.
Right. And normally when the FOMC makes a decision, especially a big one like changing interest rates, they really aim for overwhelming consensus, if not, total unanimity.
It's about the messaging.
It is. It's a form of messaging. They want to project strength, clarity. So if you see one member dissent, maybe two, that's rare, but it's manageable. It just signals a slight difference of opinion.
But that's not what happened this time. And this is the core structural nugget we really pulled from the sources.
Yeah.
The FOMC is currently divided in a way that suggests a genuine, deep ideological fault line has just opened up.
Precisely. It has been more than a decade.
A decade.
More than a decade since we've seen three voting members disagree with the majority decision.
Why?
3 votes against the prevailing consensus is an earthquake in the halls of the Fed. It signals a deep structural disagreement about where to go from here. And that is a powerful signal to the market that the next set of decisions won't be easy at all.
And what's so fascinating is that the disagreement wasn't even just two-sided. It was a three-way split. You ended up with 3 distinct camps inside the committee. You had the majority who, voted for the quarter-point cut that everyone expected. That's the center ground, the cautious cutters.
Right. Then you had the dissenters who thought the Fed was moving too fast. 2 members voted for no interest rate decrease at all. They wanted to hold steady. These are your holdouts.
Okay, the holdouts.
Their philosophy is all about vigilance. They're likely worried that easing too quickly, even if inflation seems okay now, could just reignite price pressures later on. They're absolutely prioritizing defeating inflation over, say, concerns about economic growth.
And then, on the complete flip side, you had a third camp. One member who thought the majority was being far too cautious. This member wanted a much more aggressive cut, 0.5 percentage point. This is the aggressive cutter.
Yeah, and that position suggests a really high degree of concern about an economic slowdown. Or worse, an unnecessary recession caused by keeping rates too high for too long. They want stimulus now.
So when you look at that three-way split, you've got the holdouts, the cautious cutters, and the aggressive cutters. It's not just some minor disagreement over a decimal point.
No, it's a fundamental split on what the biggest risk to the U.S. economy actually is. Is it still inflation? Or is the bigger danger now a growth slowdown? They can't agree.
And that level of internal conflict is absolutely critical for you, the listener, if you're trying to predict future policy moves. I mean, if you have a policy committee this deeply fractured right now, it tells you that building consensus for any decision on more rate cuts as we head into 2026 is going to be an uphill battle.
Hmm.
And that's putting it mildly. Every meeting next year is probably going to be a struggle to reconcile these three opposing views.
It just creates uncertainty. And the market hates uncertainty.
Exactly. So that's the internal drama. Now, let's zoom out a bit and look at the picture the Fed is trying to paint for the rest of us. They know the market is going to obsess over their future moves.
And that's exactly why they have to be so strategic with their communication. So now we need to shift focus from the immediate decision to the expectations the Fed is trying to, well, actively manage. They added some very specific, very carefully crafted language to the new FOMC statement, which is a key piece of our deep dive here. And the key detail in that language is that the number of future rate cuts, if any happen at all, will be strictly data dependent. This is the Fed basically buying itself flexibility. It's a professional way of them saying, look, we are making no commitments, we are not setting any automatic schedule, and everything we do will depend on the economic numbers that come in next week, next month, and so on.
It sounds cautious, but why is that particular language so important for them to include right now?
Well, it's all about managing expectations without tying their own hands. If they sound too excited about future cuts, the market can rush way ahead. And that can sometimes create bubbles or this excessive optimism that they might later have to crush.
Ah, okay.
So by stressing data dependency, they're signaling caution, they're emphasizing responsiveness, and they're essentially telling investors, hey, don't get ahead of yourselves.
But this cautious, data-dependent language is just the appetizer for the Fed's future view. The real substance came out in their quarterly economic projections, which they release with the rate decision. People sometimes call this the dot plot because it shows where each FOMC member thinks rates will be in the coming years, and this is where some investors were truly blindsided.
That's right. The official projection, so the median expectation across all 12 members, reveals a timeline that's, well, it's almost surprisingly cautious. Given the 3 cuts we've already had this year, you might think they're on a fast track. But the official word is very different.
What's the number?
The median expectation is for just one single rate cut in all of 2026.
Just one.
Just one. And then another single cut in 2027. They anticipate that those 2 cuts, one next year, one the year after, will basically mark the end of this rate cut cycle.
Wow. Just one cut next year? That feels profoundly conservative, even with them wanting to be data dependent. I mean, we've been moving much faster than that. Why are they setting such a slow motion trajectory?
The goal here is to anchor long-term expectations firmly. Remember, that median projection is based on a survey of all 12 members. Given the internal division we just talked about, with 2 members actively wanting 0 cuts, it pulls that median number heavily toward the cautious end of the spectrum.
Right, it drags the average down.
Exactly. So they are setting a very specific, very cautious and slow timeline for the market to chew on. They're explicitly trying to prevent runaway speculation about the future. They'd much rather underpromise and maybe overdeliver than the other way around.
Well, the stock market digested all that,
Yeah.
and then completely counterintuitively, the market rallied.
Mm-hmm.
If the Fed is telling you, hey, don't expect much in 2026, maybe just one cut,
Mm-hmm.
why are investors across the board cheering the news?
Mm-hmm.
This is the central tension you really need to grasp from this deep dive.
There are 2 main reasons for that immediate positive market reaction. The first one is simply the tone, the psychological relief. Chair Jerome Powell's press conference and the official statement were, thankfully, less hawkish than a lot of investors had genuinely feared.
Okay, hold on. For someone listening who hasn't followed all the economic jargon, when you say hawkish,
Yeah.
what does that mean in practical terms for the average person?
Great question. So in this context, hawkish means being aggressive in the fight against inflation, even if it hurts economic growth. A hawkish Fed is one that's ready to hike rates or keep them high for longer. A dovish Fed is more focused on growth and less worried about inflation.
Got it.
So investors were bracing for a very tough, stern statement, maybe one that hinted the easing cycle was paused or even over. What they got was manageable, so the tone was just slightly dovish enough to provide a short-term boost.
Okay, so that's the short-term tone. But the second, and I think more profound reason for the market rally, is this key divergence in expectations. Investors as a whole are just not buying into the Fed's projection of a single rate cut for 2026. They are actively betting against the FOMC's official crystal ball.
That's it. The official Fed projection is 1 cut in 2026. But the financial markets, people putting up actual money, They're betting on a faster timeline, and we can actually quantify this divergence by looking at tools like the CME FedWatch tool.
Let's focus on that for a second. For the listener, what exactly is the CME FedWatch tool? How does it translate market feeling into a probability?
Think of it as the financial world's highly sophisticated betting odds. But instead of betting on a football game, they're betting on the future path of interest rates. It tracks the prices of Fed funds futures contracts, which are traded on exchanges. The price of these contracts directly reflects the market consensus, the collective wisdom of thousands of traders, on the probability of the Fed hiking, holding, or cutting rates at every single future meeting.
So it's real money talking.
It is. It takes that real money sentiment and translates it into a straightforward probability percentage.
And what does that tool tell us about 2026? It tells us that the market's median expectation for next year is for 2 rate cuts, not the one cut the Fed officially projects. That's a 100% disagreement on the median forecast.
And what's more, the data shows there's a 69% chance priced into the market for at least 2 cuts to happen next year.
69%.
That 69% is the key figure. It means nearly 2/3 of the trading world expects the Fed to move faster than their own official guidance suggests. This divergence between the central bank's words and the market's actions is the central conflict of this entire deep dive.
That is a huge difference in outlook between the policymakers, the ones actually making the decisions, and the money managers who are trading on them. So why is the market so confident in its rebuttal of the Fed's official number?
Well, there are 2 really concrete drivers the sources highlight for this more aggressive market view. The first is based on real-time economic signals, the significant weakening in economic data that we've been seeing reported recently. If the data softens, the Fed's carefully constructed timeline just collapses.
Can you give us a quick example? What kind of softening data is the market obsessing over?
Sure. Think about manufacturing data, things like the Purchasing Managers Index, the PMI. If those numbers come in showing slower factory activity or contracting new orders, the market reads that as a higher chance of an economic slowdown. We've also seen cooling in the job market or slower growth in housing starts. Every single time one of those indicators is weaker than expected, the probability of the Fed needing to provide more stimulus, in other words, more cuts, it just goes up. The market believes this recent data trend will ultimately force the Fed's hand to speed up its schedule, regardless of its current conservative projection.
So the market is essentially saying, we believe your data-dependent promise more than we believe your one-cut projection.
Exactly that. They believe the underlying reality of the economy will override the cautious political consensus of the FOMC. And the second factor that's fueling this market optimism is the anticipation around leadership.
That's the possibility of a new Fed chair, right?
It is. A new leader is possible in a few months, and that potential change in command acts as a real accelerator for market optimism.
Why is that?
Because changes in leadership often lead to at least a subtle recalibration in policy philosophy. A new chair, even if they maintain the overall direction, might be less constrained by the historical consensus that governed the previous chair. They might just be more willing to move swiftly if the data demands it.
So investors are pricing in not just weak data, but also the potential for a change in institutional attitude. And that fuels the bet that the rate-cutting schedule will move faster than the cautious Fed is currently letting on. It's an interesting mix of economic reality and political anticipation.
It creates leverage. When the market expects 2 cuts and the Fed projects 1, it puts immense pressure on the new leadership. They either have to align policy with what the market expects or spend their first few months aggressively fighting that expectation, which creates volatility they usually want to avoid.
So what does this all mean for us as we wrap up? We have this fascinating tension. On one side, you have the Fed cautious, dealing with unprecedented internal ideological division and projecting just 1 cut next year because they want to anchor expectations conservatively. And then on the other side, you have the market optimistic, driven by recent softening economic signals and the very real possibility of a shift in leadership and firmly betting on 2 cuts next year.
And this divergence is highly actionable knowledge for you, the listener. It means volatility is likely because either the Fed or the market is going to be wrong. When one side is eventually forced to move toward the other, you're going to see major reactions in bond yields and in stock prices.
So to quickly synthesize the 3 major insights from our deep dive today, you need to remember the rate cut itself, which was expected. Then the highly unusual 3-way split within the FOMC, which signals future difficulty in making policy and this deep philosophical disagreement. And critically, the official quantifiable disagreement between the Fed's conservative 2026 projection of 1 cut and the market's firm, money-backed prediction of 2 cuts.
And that last point really leaves us with a final provocative thought to mull over. If the consensus market expectation, the 2 cuts next year, proves to be correct, what does that fundamentally say about the reliability and the relevance of the FOMC's own forward-looking projections? They are already facing this unprecedented internal division, which suggests a lack of a cohesive vision inside the building. If the market is demonstrably better at predicting their moves than they are at signaling them, it raises some really important questions about whether their forward guidance is truly effective anymore. That credibility gap is something you must watch very, very closely as we move into the new year.